Hey everyone, my name is Aman, I'm 22, and in this video we will talk about both investing and trading and try to figure out which is better for us. And we will talk about different parameters that will help us determine this. What is investing? Investing is allocating your money to different assets with the expectations that their value will grow over time, helping build your wealth gradually. Unlike trading, investing is typically long term and it focuses on buying and holding assets to benefit from their appreciation, compounding returns, and income generation like dividends or interests. And usually, investors make use of fundamental analysis. What is trading? So trading is the active buying and selling of financial assets over short time frames such as minutes, hours, days or weeks to profit from price fluctuations. And a trader takes advantage of market volatility and aims for quick profits rather than long-term growth. And a trader makes use of technical analysis. So why does it even matter? The biggest reason for being unsuccessful at both trading or investing is having false expectations. They both serve very different goals. If you look at trading as a method to build a retirement fund, it is equally as wrong as you investing with the expectations of getting rich quick. So don't invest thinking you're trading and don't trade thinking you're investing. The goal of trading is to capitalize on short-term market movements, generating immediate returns rather than holding assets to grow over the years. Never think of trading as a means to retire in life. Yes, it might make you a lot of money, but the outflow is equally high in this game, and not much is guaranteed as a trader. The primary aim of investing is wealth accumulation and financial security over the long term. This could mean saving for your retirement, or saving up to buy a house, or it could be funding your child's education. If you look at Nifty 50's chart since inception, it is upward sloping. And there hasn't been a 5-year period of investing in Nifty 50 that would have resulted in a loss. So in investing, unlike trading, it isn't you being right versus someone else being wrong, but it is more like you being right versus someone else being more right. This is given if you invest for a long horizon. 93% of all traders are loss making, with an average loss of 2 lakhs per trader. Now, I am not saying this. This data was reported by SEBI. So you have to be in the top 7%, not even to be an exceptional trader, but just to break even at the least. Also, trading requires a lot of frequent buying and selling, which exposes you to a lot of volatility. The fast-paced nature of trading can lead to impulsive decisions based on your emotions rather than rational analysis. Also, frequent trading incurs higher brokerages and other transactional costs, which can erode your returns. And the potential for significant losses is higher while trading due to market volatility and the possibility of incorrect predictions. Even long-term returns are subject to market fluctuations, which can impact the value of your portfolio. Also, over time, inflation can erode the purchasing power of your investments, reducing your real returns. Some investments, such as real estate or certain mutual funds, may have liquidity constraints, making it difficult to sell them quickly. Also, investing in individual stocks may expose you to specific risks of the company, such as poor management or financial difficulties or industry downturns. When you trade, you are taxed on short-term capital gains, which is 20% tax on any little gain that you make. And on top of that, a trader sets up multiple trades in a year. And for every trade, you have to pay brokerages. When you are a long-term investor, the first 1 lakh of your long-term capital gains is completely exempted from any tax. When you cross that 1 lakh mark, you have to pay 12.5% on your gains. And long-term in taxes is 1 year and above. Compound interest rewards patience. It's a cornerstone of long-term investing, allowing wealth to grow steadily and significantly over decades. This particularly makes it beneficial for retirement planning or other major financial goals. Suppose someone invests 1 lakh at 15% return and leaves it invested for 40 years. By the end, due to compounding, their initial investment could grow to nearly 2 crore 70 lakhs, even without adding additional funds. If you bought Nifty 50 20 years ago, it will have compounded multifolds by now, and the risk also would have gone down with time. But if you traded on FNO on Nifty 50, every trade you made had high exposure to risks. Whether you would have grown your wealth is inconclusive. For example, a trader might make a 5% profit on a trade and immediately reinvest that amount in a new trade. However, with each trade carrying the risk, they may lose the 5% in the next one, resulting in no compounding effect or wealth growth over time. This might not be the case for every trader, but the risk does hold. Investing is generally suited for individuals who seek steady long term growth, such as those aiming for retirement or financial independence, or people with lower risk tolerance, or somebody who doesn't want to monitor the markets all the time. This is an ideal approach for somebody in their 20s who wants a hands off, reliable way to grow wealth gradually. On the other hand, trading is better suited for individuals with a higher risk tolerance who enjoy actively engaging with market and analysis and are comfortable handling frequent losses. Trading appeals to those who thrive on high adrenaline decisions and can commit to regular active involvement in the markets. Historically, long term investors who hold diversified portfolios like index funds, stocks, bonds tend to achieve steady compounded returns. By avoiding frequent buying and selling, investors benefit from the power of compounding and are less impacted by market timing risks or fees, which can erode a trader's profits. Trading, on the other hand, involves frequent transactions that come with high risks, fees, and the pressure of timing the market perfectly. Factors that make it harder to achieve consistent, reliable returns over the long period. While there are some traders that do achieve impressive returns in the short term, but long term investing is generally a more dependable path to building your wealth for most people. We have reached the end of the video. Do like the video and let me know which according to you is better, investing or trading.